Take a look at China and you'd be seeing it much like Japan in 1989. And apparently, we are headed for quite a bit of a problem. You know, it's highly possible that what happened is going to be pretty bad soon. And this is because of China's economy. Their economy is on the road to ruin as it heads for a huge market crash. And it would take decades for the rest of the world to recover from it if it is anything like Japan's devastation in the 80s. Frankly, it has been 3 decades since that event, and Japan's stock market has yet to recover from it. Their market crash was brought about by several warning events that took place until it eventually dragged the country into economic hell. And with that information, there's a chance that China's economy, China, has already crashed. This video will explain a theory from Cathie Wood, who believes that China has found itself in a major bubble and is heading for possibly the largest crash ever. Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started. Over the last few years, China's housing market has significantly increased. This is demonstrated by the constant rise in China's housing prices. With most investors unaware of what's happening, China's real estate bubble was so close to popping and it wasn't gonna look pretty. Right before we tell you the indicators, let's go over the striking similarities of China in 2021 and Japan in the 1990s. In the past decades, China's real estate developers have grasped up in order to further expand their real estate portfolios in a quick manner. This actually sounds reasonable at first, but it also means that the market is completely vulnerable when it moves forward. We saw this happen with Evergrande, which is the most indebted real estate developer in the world. The competition is also very evident among the rest of the Chinese real estate companies. We have at least 4 other major developers from China who have defaulted or asked their investors for some time to repay their debt, namely Fantasia Holdings, Modern Land, China Properties, and Xinyuan Real Estate. All of them continuously fail to pay their debt, which goes up to around hundreds of millions. According to sources, Chinese developers took out as much as $5 trillion during the Chinese bull run. With a leverage this big, it's almost impossible to stop a market crash from happening. This is quite similar to what happened to Japan back in the 1990s. From 1990 to 2003, Japan's Nikkei index crashed to around 80% from its record highs, and currently, their index is still yet to redeem those high levels. These were known as the lost decades, with investors still down to a maximum 25% after 30 years. Can you imagine investing into the S&P 500 but still remain stuck below 25% after all those years? Painful, really. So, if China were to have that kind of economic destruction, it would not only affect their population in the country, but also globally across many other countries. You see, Japan was at the height of their real estate boom back in 1989. When their Nikkei index reaching to 40,000, the rest of the globe were rooting for Japan, praising their economic rise to being possibly the biggest economy in the world. Yeah, that didn't happen. The real estate boom was going to slowly come undone. A lot of the people probably heard about the Emperor's Palace, a piece of land back in Japan, that was worth more than the entire state of California. It was actually destined to fail, and now their Nikkei is still struggling to climb back to its rate of 40,000, even more than 30 years later. A credit analyzer, Moody's, says that approximately 70 to 80% of China's household wealth is tied up in real estate. So this means if the country's real estate market crashes, so will 80% of China. And this would result in the whole global economy freezing. A lot of countries, if not all, depending on China for different products and manufacturing. Basically, a crash in China coming from a real estate crash would catalyze a slow production of various goods worldwide. The crash is expected somewhere during the first quarter of the year 2022, which, as you know, is basically right now. Goldman Sachs was able to calculate that China has around $6 billion in debt to pay by January 2022. That is significantly higher than the current developer debt payment of less than $2 billion back in November, just a few months back. No surprise that a lot of Chinese companies already are way behind in their payments of their respective debts. But can you picture out what would happen if the payments explode in the coming months? Another catalyst to China's economic downfall would be their communist group's attempt to cracking down illegal real estate deals. Strict regulations were regulated by the CCP on the real estate companies to ensure its quality service to society. We think it's marked with good intentions, but Cathie Wood believed it to be them playing with fire. And we all know what happens when we play with fire. Ouch. According to Cathie, China's real estate has been seriously boosting its country's economy in moving forward. It was part of the country's infrastructure when they built their economy. It is also crucial when it comes to consumer savings because approximately 75% of China's consumer savings are in real estate. But now, China's real estate is a little bit shaky and housing prices are hitting low rates. It might have caused a bit of a stir with the Chinese as well. The experts have been trying to tackle several issues in the economy because what we can see is an overwhelming comparison. Some people are able to afford to live in luxury properties while others beneath them can barely stay on the streets with a roof on their heads. But the Chinese leaders have essentially tolerated this kind of truth. So, this is driving their prices downward and affecting those who actually had money initially, and they're gonna lose it, their money. But China is willing to risk it. Like we mentioned, they're basically playing with fire because they are also touching the financial regulators who oversaw financial institutions who were lending to the real estate sector. Several financial firms are also being investigated by the Chinese government. Real estate has been the gears behind their economy after all. China's demands for commodities is 15% of the whole world's GDP, with the rest of the commodities having higher demand rates from China as well. Like we mentioned, China is a pretty big catalyst for most of the world's economy. Among these commodities are iron and copper, which, by the way, are crashing at an insane rate as of this moment. Iron has dropped more than half of its percentage in the last couple months. Even though it has tried to climb back up in the recent months, it has basically relapsed as it hit new lows. Copper prices are also down by 10 or 15% in the market, but it's still in a safe zone compared to historical matters. But nevertheless, there is visible decline. When a commodity's price declines, it seems beneficial to a lot of companies across the globe. It typically brings out a lower cost of goods, or COGS. This then brings them a higher profit margin. However, what's happening right now is a bit different. Decline in prices is just proof that the Chinese economy is slowing down, and if it continues to do so at a significant rate, the whole world's economy will inevitably follow. It's surprising that no one really points out the possible correlation of China and to the world's commodities. So, since commodities are beginning to falter their prices, it's highly possible that China is starting to falter as well. And like we mentioned, that is not good. Cathie believes that investors already know how a further crash is bound to happen. What she doesn't understand is why is the media, or economic media at least, keeping quiet? These warning signs should have been made aware considering how much of an impact it's going to make globally. But maybe it's because it's being shadowed, but much more complex or different issues are going on the other side of the economy. Different issues that are taking more space in the headlines. At some point, Cathie believes that the world's investors would come to a sudden realization that they have been ignoring what was going to happen. So if China's economy is in deep waters, so is the United States. Although not to the same degree, the Feds have already warned how a market crash from China can seriously impact the US. Recently, they have put out their semi-annual financial stability report, and there was a bit of a red flag on that report. It was the Feds expressing their concern over the China's real estate bubble suddenly popping. They quote, "Stresses in China's real estate sector could strain the Chinese financial system, with possible spillover to the United States." They also stated how the debt of the Chinese government and some business sectors remain large, with a high leverage from the financial sector. With around $5 trillion of debt, China is on a cliffhanger. Their increased regulation might just be the tipping point. Moreover, the important note from the Feds is the effect of China's crash on the United States. They quoted, "Given the size of China's economy and financial system, as well as its extensive trade linkages with the rest of the world, financial stresses in China could strain global financial markets through a deterioration of risk sentiment, pose risk to global economic growth, and affect the United States. Adverse developments in other emerging market economies spurred by a sudden." Among the Fed's concerns, we could see a list of potential shocks that can hit the US economy while it tries to go forward. It was created by 26 market experts and is accumulated to create a percentage-based statistic. It shows that almost 50% of market experts see China regulatory and property risks as a potential danger. Listed is also the US-China tensions, which they believe is also an area of concern. And to top it all off, 15% of market experts highly believe that China's slowing down could be bad news for the US. Now, the Feds have obviously pointed out their concern for China's crash, even for the US. Cathie Wood also believes that this will severely affect not only the States, European countries as well. She states that China will shock the world with its vulnerability all of a sudden. This can result in the US taking a hit, Europe taking an even bigger hit. And that's because Europe has been China's trading partner to a bigger extent than the United States. What investors can do is to soften the blow to reduce their exposure to China and their market. This includes corporations in America that rely on Chinese goods as well. If we take a look at the lineup of American corporations, a good number mostly do not invest in China. The only company on top with a significant rate of exposure to China is Tesla. And even for the automotive giant, it's not a big area of concern. CEO Elon Musk does not have to worry about a crash for the demand of his Tesla vehicles because it has already reached a safe peak. So, here we come to a conclusion that China could be dramatically slowing down as explained by Cathie Wood. We would all hope that our investors steer it to a more plausible direction, or else this crash could be the next US import that's made in China. For watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.